Hi, I'm Mike Helveston with Whitford Financial Planning, and today we're going to discuss 3 financial rules of thumb that you probably shouldn't follow. The main problem with rules of thumb is that they're typically generic and assume that every situation calls for the same solution. Many financial guidelines start with good intentions, but often they're misinterpreted or don't consider all of the relevant information. The following 3 rules of thumb should be heavily scrutinized or discussed with a financial planner who can help you apply them appropriately. So number 1, you only need 75% of your pre-retirement income to live comfortably in retirement. So unless you plan on cutting back on travel and recreation in retirement, you'll likely need close to the same amount or more to live on. The first 10 to 15 years are most likely to be the active ones, so you need to plan on spending at least the same amount as while you are working. The second rule of thumb is that to determine the right percentage in stocks in your portfolio, you can subtract your age from 100. So this rule is severely flawed because it fails to look at the whole picture. For example, if you are 50 years old and apply this rule, then it would say 100 minus 50 would mean 50% would go in stocks. And we're talking about stock mutual funds, well-diversified investments, ETFs, something like that. But what if you plan on working 20 more years, or you will have a large pension when you get to retirement? If that's the case, then this rule may give you a result that's too conservative. It's also very important to consider things like life expectancy, the impact of inflation, and of course, your personal risk tolerance should be considered in determining the right mix of investments. And the third rule of thumb that you probably shouldn't follow is that you need to save $1 million to retire comfortably today. In fact, the number you need to save is based mostly on your annual expenses, which is what you spend in retirement. So it's really personal, and that number could be higher or lower for each family or situation. So if you can live on $40,000 a year in today's dollars from your investments, plus other income such as pensions or Social Security, then maybe $1 million would be a good number, which is further complicated by another rule of thumb, which says that you could spend 4% of your principal, or $40,000, which is 4% of $1 million, and your portfolio will last over time. But really, it's important to look at your overall withdrawal rate over time based on how your accounts are growing over time and all the other important aspects that are personal to your situation. So you should really consider running your own numbers through a retirement calculator or contact us to come up with accurate targets for your personal situation. You can learn more by visiting our website at whitfordfp.com, and we'll be glad to help you out.